Good morning, and thank you for joining today's webinars. I'm Dina White, the Director of Marketing at First Long Island Investors. First and foremost, we hope everyone is in good health and doing well today. We have a lot of great information to cover today, so let's get started. I'm joined this morning by some key members of our investment committee. Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer. Philip Malakoff, Executive Managing Director and Director of Research. Brian Gamble, Senior Vice President, Private Wealth Management. And now I have just a few logistical items. All participants are currently in listen-only mode. After the team delivers the presentation, we will have time to answer questions submitted throughout the presentation, as well as some we received in advance. Please feel free to submit questions as we go through the presentation by using the dialogue Q&A box. At this point, everyone should see a slide with today's speakers. If you're not seeing that, please let us know by typing something into the chat area, and we will help try to troubleshoot. And finally, our General Counsel always asks us that we remind you today's session may discuss the performance of some strategies, that past and performance is not a guarantee of future results. To the extent that specific company names or investments are mentioned in today's presentation, they are included as examples. Some, all, or none of these companies and investments may or may not currently owned, may or may not have been ever owned by FLI various strategies. Nothing herein is intended to be a recommendation to buy, sell any particular security or to invest in any particular strategy. And now I hand it over to Bob.
Thank you, Dina, and good morning, everyone. Our agenda this morning is a pretty simple one. We're going to give you our view of the economy for this year. We're going to discuss significant investment themes that we think can be fruitful as investments going forward, and we'll be spending a great deal of time researching them. We'll have a summary, and then we'll have a Q&A period where we'll answer, hopefully, all of your questions. Next page, please. Before I go into this slide, which is one of our favorite ones, I would just like to remind everyone of the quote from our thought piece that was published during January. And that was a quote from the late Charlie Munger, who was Warren Buffett's late and longtime partner. And Charlie said, "You make a great deal of money by being patient." That was a keynote to our thought piece, and it reflects the philosophy of First Long Island Investors. The big money is not in the buying and selling, all right? It's in waiting. It's in prudent analysis. It's reviewing opportunities and valuation. And where we have a good company, even if it's going up and we see much more opportunity, we'll hold on to it. And if we have a good company and for some reason it goes down, as many went down in 2022, we didn't run, we held on, and we did very well in 2023. So again, in our view, like Charlie Munger, may he rest in peace, great investor, the big money is not in the buying and selling, but in the waiting, having that conviction and that patience. Now, this slide is one of our favorites. I think you have heard from us before that we believe there is a relationship between monetary growth and inflation. You know that earnings, interest rates, and inflation are key components to our success as investors. This favorite chart of ours shows the relationship between M2, money supply and growth, and inflation. Inflation or lack thereof will greatly influence the Federal Reserve, which can affect our investment performance. And as you can see from this chart, the blue line, which represents monetary growth, showed a spike during COVID. It also reflected the red line, which shows inflation peaking up and then going down as monetary growth went down. In 2022, the Fed raised interest rates in an unprecedented manner. 5 75 basis point increases as inflation went up and monetary growth went up. And you can see that reflected on this chart. In 2023, as the impact of dramatically reduced monetary growth affected markets, inflation started to recede. It went from as high as 9% down to the 3 to 4% level at this point. That put a stop to the Federal Reserve raising interest rates. That led to a robust performance in the equity markets. So in 2022, we suffered as rates went dramatically higher following inflation. And in 2023, as inflation came down, rates were held by the Federal Reserve with the anticipation that in 2024, rates would come down as inflation continued to come down. And we shall see if that happens. Next page, please. Next slide. Now, this is a different way to look at inflation and is very relevant to the average American today. We call this and Strategis, as you know, is an outside consulting firm that we use and have used for many, many years. This is the common person's, I'll be politically correct, CPI versus wages. So this is what the average person is feeling in the United States today. An accumulation of inflation between 2020, 21, 22, into 23, reflected by the blue line, which shows a high level, and then wages, growth in wages, in the red line. And as you can see, the inflation has outpaced wages. So when you hear people complain about food costs, insurance costs, housing costs, the aggregation of them still is leading to discomfort for many Americans today, irrespective of monies they may have gotten during COVID. So the embedded inflation is still hurting the average person. And we believe that's why President Biden and the current administration's polling results on the economy are pretty dismal, actually very, very low. That could have potential impact in the election cycle this year, which we'll be discussing a little bit later. But again, the key here is that for the average person, even though we're reading about inflation coming down, it's coming down from 9% to 3 to 4%. That's great, but that doesn't undo the embedded inflation that most Americans are dealing with when they go to the supermarkets, as an example. Next page, please. Now, the economy is made up of consumers and business. 70% of the economy is driven by the U.S. consumer. So we want to show you that the consumer remains strong. The chart on the left is the household excess savings. Again, excess savings, much of which was accumulated during COVID when the government handed out a lot of money to stop the country from going into a deep recession or a deeper recession. And you can see by this chart that although the amount of excess savings has declined, there still is a significant amount of excess savings, which bodes well for future spending by consumers. At the same time, on the chart on the right, showed households and nonprofit organizations' net worth, which is another reflection of wealth. And this reflects the excess savings. It also reflects household values, which we know have gone up. And as you can see, this chart also reflects a very, very strong consumer. So between excess savings and net worth, we still have a consumer that is spending, and we can say, as we did last year, we didn't think there would be a recession. Some folks did. We turned out to be right last year. There was no recession. We believe there'll be no recession this year. There'll be a moderation in GDP growth as the year goes on, but we do not believe there'll be a recession this coming year or this year in 2024, particularly led by the consumer, who we believe is still very strong. Next page. Now, we've always got to look at different aspects of the consumer. Are they accumulating a great deal of debt? So these two charts are reflective of the fact that even though debt has ticked up a bit, it's still way below pre-pandemic levels and still way below the period of time in 2008 and 9 when there was a banking crisis and consumers were in big trouble. As you can see, the household debt service ratio remains at a very comfortable level, and again, well below the pre-pandemic. And as you can see, revolving consumer credit on the right as a percentage of disposable income, still very, very comfortable for the consumer. Now, that doesn't mean all consumers, but the vast majority of consumers, as reflected in these two charts, depicts a consumer that is not underwater with debt at this point. So we've got good household savings, we've got good net worths, and we've got debt under control. So again, in our opinion, no recession this year. Next page, please. Now, one last point on the consumer is employment. Very, very important. One of the points we raised last year throughout our thought piece and our quarterly reports was that we didn't believe there would be a recession when we had unemployment under 4%. We continue to have unemployment under 4%. And as you can see from these two charts, and I'll start with the chart on the left first, the unemployment rate remains under 4%. The total number of people in the workforce continues to increase and is robust. So we have a lot of people working, and we have a very low rate of unemployment. And the chart on the right is the JOLTS number, the job opening unemployment ratio, which means that there are more jobs available than there are people unemployed. And even though the number has ticked down a bit, the 1.44, as you can see, it still reflects a very, very healthy employment situation. So again, we don't feel at this point, unless there's some major extraneous event, that we're going to have a recession. We believe 2024 will be another year without a recession. Next page, next slide, please. Now, the other part of the economy is the business economy, which is at least 30% of the economy. And here we have to focus on whether or not our businesses are vibrant and strong, and whether or not our banking system is strong. So notwithstanding the fact that we had a mini banking crisis last year, which scared a lot of people, our tier 1 risk-based capital ratio is very high for our banking system. And the government is very careful, especially after what happened in 2008, to ensure that our banking system has sufficient capital to operate even under stressful situations. So again, we take comfort in the fact that our banking system, as based on a tier 1 capital ratio, is strong. Now, having said that, we are aware of the fact that there are certain real estate sectors that may be weak, that maybe need to be refinanced, and we are watching that carefully. But in our analysis of the major banks that we follow, both the big money center banks and the super regional banks that we follow, we see very little exposure to commercial or office real estate where there may be an issue. It may be more of an issue for very local banks that lend to those individuals. Given refinancings now at higher rates, there could be an issue. But we do not think this poses a threat to the banking system, and we take comfort in this high level of capital that our banking system has. The other part of the equation is the manufacturer's new orders, non-defense capital goods excluding aircraft. This is a picture of how robust our manufacturing is in the country. And as you can see, where it dipped during COVID, it's now gone to a point, a very high point, which indicates that our manufacturing new orders are robust. And this also contributes to the economy. So again, these two factors lead us to believe that there won't be a recession this year and that the economy will be reasonably strong. Reasonably strong economy should support reasonable earnings. And we'll get to that in a second. There's a third component to this that I want to raise, which is not depicted in a chart, and that's government spending. As you all know, and I'm sure we'll know much more, hear much more, we are in an election year where the Senate, many of the Senate seats will be up for election, all of the House seats will be up for re-election, and of course we'll be electing a president. And the government in the last several years, which has led to the growth in money supply and also led to a bit of inflation, or quite a bit of inflation, passed 3 bills that are still operative: the CHIPS Act, the Infrastructure Act, and the so-called Inflation Reduction Act. Those 3 pieces of legislation committed well over $1 trillion to government spending that has yet to be spent. So we believe in the course of this year, particularly because it's an election year, and the incumbent administration wants to ensure, to the extent that it can, that there's no recession, they will be spending monies from those three acts. That will bolster the economy and particularly bolster manufacturing and the business side of the economy, as well as providing for more robust employment. So this year should turn out to be a decent year from an economic standpoint. If we go to the next slide, and this is one, of course, that we always talk about because, as we said before, interest rates and inflation will trend down, in our opinion, this year. But what we always look for at First Long Island in the companies we invest in are growing earnings. And here's the S&P index earnings as projected. Of course, there are projections. And as you can see, there's a growth in 2024 over 2023. There's further growth projected in 2025 and 26. So that outlook for earnings growth is important to our view that we could have a decent year in equity performance for the companies that we invest in. Interest rates and inflation will trend down over the course of the year in a slow way, in a bumpy way. We did not expect, and we put this in our thought piece, we did not expect a rate decrease in March as many on Wall Street did. We believe rate decreases will occur during the middle to the last half of the year, and there'll probably be a few of them, maybe not as many as Wall Street is projecting. But our earnings are forecasted to increase. So if we do have a continuation of declining inflation, although not straight line, and if we do have some reduction in interest rates, and we do have an increase in earnings for the companies we invest in, it could turn out to be a pretty good year. And with that, I'll turn it over to my partner, Phil Malakoff.
Thanks, Bob. It's Brian. All right.
I'm sorry, Brian.
That's okay. All right, I'm going to start by taking you through some investment themes this morning. Kind of going to hitchhike on where Bob left off in terms of corporate earnings. As Bob said, business conditions generally remain favorable, but that hasn't been reflected in all stock prices. As you can see on the chart on the left, and as we've heard, obviously, in the media, the Magnificent Seven have really galloped ahead this year or in the last year plus. And there's been a big divergence between the Magnificent Seven and the rest of the market. You can see that with the Magnificent Seven being up 125% versus the S&P on a cap-weighted basis, where those play a large role, up 33%. But on an equal weight basis, the average company is up only about 16% over the last year and a month or so. So while the conditions remain good, there's been a generally divergence in the stock prices amongst those companies. Now, in terms of the Magnificent Seven, they're generally highly profitable growing businesses with valuations that we believe are not astronomical at this point. But this outperformance by the Magnificent Seven has led to a high level of index concentration, with the top 10% making up 32% of the S&P 500. But when you dig down into earnings, they actually only represent about 23% of earnings. Again, for a lot of these, we don't believe valuations are stretched, but they're certainly not cheap either at this point. Also of note, if you look, we're at about 32% of the index. The last prior peak was, in late 90s, early 2000s, give or take, 26, 27%. But this isn't 99, 2000 all over again. These are highly profitable, cash-rich companies that we're talking about. These aren't companies that are trading or have very little cash on their balance sheets or are trading on earnings that haven't materialized yet. The other point that I think is worth making is that high index correlation in the past hasn't been correlated with good or bad market performance. So really, the level of concentration is just something that bears monitoring, but it hasn't been an indicator one way or the other of market performance. So if we could switch to the next slide, please. And as Bob mentioned also earlier, this is an election year. At this point, with Biden likely running for re-election, it makes sense to look at the market performance during years when a president is seeking re-election. The average total return in a re-election year since 1944 was just under 16% at 15.8, and has been positive the last 13 times we've had a re-election year. Also, and you can see that on the left-hand side with all the positive results since 1944. Also, if you look at the chart on the right, you can see the market typically performs better during a potential re-election year than during an open election where there's no incumbent seeking re-election. So again, that's the situation that we're in at the moment. So we remain cautiously optimistic on this year. So we'll see how that goes. But additionally, as Bob mentioned, the incumbent also typically increases spending with hopes of re-election, which could spur the market on further. Bob mentioned the CHIPS Act, the Infrastructure Act, the Inflation Reduction Act, which are all tools available to the current administration to boost spending and could have a positive impact on the market this year. Moving to the next slide. Another important theme over the last several years has been growth versus value, and we've discussed this in many of our letters. But there's been a divergence. As you can see, last year growth outperformed by over 3,000 basis points, while value outperformed by over 2,000 basis points in 2022. But if you look over recent history, growth has outperformed in aggregate for the last 17 years. And also, it's not shown on this chart, is that growth has started the year outperforming value again. But with that said, style leadership can switch quickly, as we've seen over the last 2 years. And because of that, it's important for a prudent asset allocation to have exposure to both, as we can't predict from one year to the next, which will outperform, as we focus typically on the longer term results of companies that we invest in. Next slide, please. Staying on the theme of growth versus value, it's interesting to note the divergence in the performance based on the yield of the 10-year U.S. Treasury. As you can see in the chart, growth outperforms significantly when rates are low on the left-hand side. 15 versus 11 and 19 versus 10 in, call it 0 to 2 and 2 to 3% 10-year Treasury environments. Well, value tends to modestly outperform as rates get higher. So in the 4 to 5 or greater than 5, you have value slightly outperforming. But with the exception of the 3 to 4% range, you can see that results on an absolute basis are all pretty attractive. So that gives, again, that we remain cautiously optimistic on this. And with that, I will pass it to Phil to take us further into the investment themes.
Thanks, Brian, and welcome to everyone. Thanks for joining us. So I'm going to talk about areas of opportunity. So in conversations with clients, I'm frequently asked where we're seeing opportunities in the equity markets. The simple answer is we are looking to identify great secular and durable growth companies for our growth strategies and inexpensively valued, possibly dividend-paying and dividend-growing companies for our value strategies. These companies tend to be high quality, companies taking market share in growing businesses, companies both broadening and lengthening their revenue runways, companies with high recurring sales, companies with strong management teams, clean balance sheets, and trading at attractive valuations. And while we're not thematic investors, there are certain areas that we've been drawn to over the years. And currently, there are a number of areas where we see opportunity. In very broad strokes, these companies are involved with technological advancements, lifestyle evolution, and industrial innovations. Let's go to the next slide, please. Regarding technology, the biggest advancement over the past couple of years, and the one that has garnered the most attention recently from the public, is generative artificial intelligence, or AI. And within AI, there are two types of opportunities that we have found: infrastructure plays and end users. But what exactly is AI? Artificial intelligence makes it possible for machines and computers to learn from experience, adjust to new inputs, and perform human-like tasks, in many cases more efficiently and less expensively. There are a number of companies that are providing the infrastructure for AI's development, and by infrastructure, I'm referring to the hardware, manufacture of that hardware, semiconductor chip design, software coding, distribution, and intellectual property, all of which goes into AI and makes it available to users. One company in this space is ASML, which is involved in manufacturing machinery that is used to make the semiconductor chips that power AI. ASML currently has a monopoly in manufacturing extreme ultraviolet lithography machines. These machines are as big as a bus and cost in excess of $150 million and are the best way to manufacture the highly complex circuit patterns on silicon-based semiconductor wafers. Demand for these machines is expected to increase materially as we approach 2025, as major semiconductor manufacturers are expanding capacity by building new fabrication plants, which require ASML machines. Some other companies involved in creating the infrastructure for AI include Microsoft, Synopsys, American Tower, and the company that has really driven the advancement of AI, NVIDIA. NVIDIA is the dominant AI chip manufacturer and has a big advantage since the company's software and graphic processing units, or GPUs, are much better suited to handle AI's heavy workloads than traditional central processing units. NVIDIA's high-end Tensor Core GPU, the technology of which originated from the company's legacy computer gaming business, costs as much as $40,000, and the supercomputers that power AI require thousands of these GPUs to operate. NVIDIA continues to upgrade its chips and GPUs at higher price points, and there appears to be limitless demand for these products thanks to their value in accelerating AI workloads. As evidenced by last night's earnings report, NVIDIA can't produce anywhere near enough chips to satisfy its order flow. Demand for AI from end users is growing exponentially, and software companies such as Adobe, ServiceNow, and Snowflake are adding AI co-pilots and assistants with their pipelines, according to NVIDIA's chief financial officer. In fact, 9 out of 10 organizations said they support AI for gaining a competitive edge over their rivals. Alphabet, which is the corporate name for Google, Amazon.com, Autodesk, and Accenture are also large users of AI. Another company which is using AI to further its growth and has been for nearly a decade is Intuit. And while you may not be familiar with its corporate name, Intuit has product offerings such as TurboTax, QuickBooks, and Credit Karma, which have high brand name recognition. Intuit has its own AI development environment called GenOS and has developed its own large language models, or artificial neural networks. And it uses these to assist its customers by answering questions in real time, suggesting individualized tax tips, or guiding users through changes in the tax code for TurboTax users. For other products, it can draft invoices, identify gaps in cash flow, and suggest avenues to pursue to cover the gap, and creates personalized responses to customer inquiries. Intuit introduced Intuit Assist late last year. Let's move on to data analysis, which is another emerging topic in the technology space. And many companies that have large databases of consumer behavior are or will soon be able to monetize that data. So data analysis is the process of inspecting, cleansing, transforming, and modeling data with the goal of discovering useful information in order to predict behavior, support decision-making, and develop strategies. It has been said that data is the new oil, alluding to the fact that neither is useful in their raw states and need to be refined in order to provide something useful. Some companies that are at the forefront of data analysis include Microsoft, Accenture, Automatic Data Processing, and Adobe. And during its recent earnings call, Amazon.com mentioned that it had launched a virtual assistant named Rufus, which will combine AI and data analytics to provide shoppers with purchase suggestions based on analysis of data from that particular shopper and their peer group. While cloud computing isn't experiencing the tremendous revenue growth it did when it was a relatively new way of storing data, it is still a massive opportunity with a nearly $500 billion total addressable market, and that was in 2022. It is expected to surpass over $1 trillion in revenue by 2028 and $1.6 trillion by 2030. Microsoft, Amazon.com, and Google are the acknowledged leaders in this space, and their respective cloud businesses, Azure, AWS, and Google Cloud, have been important drivers of their earnings growth over the past few years. Software as a service, otherwise known as SaaS, has been transforming companies' business models by changing them from sellers of shrink-wrap software programs, which provided the seller with a one-time fee, to a subscription model where the software is in the cloud and the company is collecting revenues on a more regular basis. Salesforce was one of the first innovators of this strategy, which is now employed by many others such as Intuit, Microsoft, Workday, Zoom, and ServiceNow. Adobe made the change to SaaS about 10 years ago, and over the past 10 years has seen its revenues increase fivefold and its stock price tenfold. Cybersecurity is a major problem and one that isn't going away. It is said that there are two kinds of companies, those that have been hacked and those that don't know they've been hacked. Additionally, cyber warfare is an area that is concerning as countries attempt to weaken, disrupt, or destroy other nations via computer attacks. Last year, I had the opportunity to hear retired Admiral James Stavridis, who was also the former Supreme Allied Commander of NATO, to speak in a small and private setting about cyber warfare. He believes that both China and Russia possess powerful offensive cyber capabilities, and he is concerned that cyber attacks from one of those countries could do real damage to the United States. And you may have heard that early this morning, cell service for 3 major and a few smaller carriers was interrupted for hours, leading some to speculate this was due to a cyber attack. Unfortunately, this is an investment opportunity that will be with us for the rest of our lives. Microsoft, Accenture, Palo Alto Software, Fortinet, and SentinelOne are companies addressing this issue. Let's go to the next slide, please. So here we're going to talk about drivers of GDP growth. And all of the technological advancements that I just discussed lead to one important outcome, that being increased output per worker or increased productivity as more goods and services are produced for the same or fewer hours of work. Worker productivity is an essential part of expanding our economy, as a more productive economy is more efficient and able to drive capital growth. On this chart, you can see how growth in output per worker in blue has been at least half of GDP growth in 6 of the past 8 decades. And so far this decade, as AI, data analysis, and the others have become more accepted and common in the workplace, increased productivity is accounted for 1.5% of the 2% growth in real GDP. The other input, which is a driver of GDP growth, is growth in the number of workers, which you can see in olive green. Having more skilled workers included in our economic reports has historically led to an improvement in economic growth. Let's move on, please. So there have been some incredible advancements in a number of areas which have improved how we go about making our lives more enjoyable, more efficient, more productive, and healthier. While the world has been moving away from cash and checks as a medium of exchange to digital or electronic payments for many years, the global pandemic accelerated that change. Consumers around the world have migrated to using credit cards and digital payments as a substitute for actual currency, and there are an ever-expanding number of ways for people to pay for goods and services. Mobile wallets such as Apple Pay and Google Pay allow users to keep a physical credit card stored digitally on their phone, so all they need to do is wave their phone in front of a scanner and a payment is recognized. Biometrics have also entered the payment space. For instance, when I pick up lunch at Whole Foods, which is owned by Amazon.com, there is a biometric palm reader that connects to one of my credit cards. So all I do to pay is hold my palm above the reader and it electronically connects to my card. It's quick and it's seamless. Additionally, MasterCard, Visa, and PayPal are also beneficiaries of this ongoing transition. Another area that saw an upswing during and following the pandemic is how consumers shop. And that experienced a transition from bricks and mortar retailers to online sales. Amazon.com has certainly been a beneficiary of this transition, as has Nike, which focused on its DTC, or direct-to-consumer business. More traditional retailers such as Williams-Sonoma and Lowe's have become omni-channel as well, as they are making online sales a more important part of their business models. Online advertising is not a new concept, but has evolved into a cash cow, providing steady growth for companies that excel at it. According to one research firm, digital online advertising was projected at $602 billion last year. Many companies have garnered tremendous revenues from their ads, which are targeted at consumers based on their personal metrics, demographics, and previous histories. Google realized over $250 billion in advertising revenues in 2023. Meta Platforms, $131 billion, and Amazon.com, $46 billion, and that was up 27% over 2022. Another area which has improved our lifestyles are disruptive digital platforms, which are enclosed ecosystems that provide a dedicated service. Uber, for example, is primarily a ride-hailing service, with the user determining what level of service they desire and at what price. Uber has disrupted the legacy taxi and car service industries. Airbnb is another digital platform, providing a medium for users to attain short and long-term property rentals around the world, disrupting the hotel industry. Netflix is the most profitable entertainment streaming platform. It offers a wide variety of TV shows, movies, documentaries, gaming, and soon sports entertainment, much of it original programming. Netflix's streaming service has disrupted the linear television business. However, consumers will not be able to enjoy all of these lifestyle evolutions if they are not in good health. And there are literally thousands of companies which are working to develop treatments, solutions, and devices to improve human health. Abbott Labs, for instance, offers a broad selection of medical devices such as Freestyle Libre and MitraClip, which address diabetes and heart disease respectively. The company is also a leader in developing diagnostic instruments for a wide variety of uses, as well as pharmaceuticals. Danaher offers a broad range of research tools that scientists use to study genes, proteins, metabolites, and cells in order to understand the causes of disease and identify new therapies and test new medicines. Illumina is the global leader in sequencing human DNA, an evolving field. Intuitive Surgical is the leader in providing robotic surgery machines, which are using AI to improve diagnosis and outcomes. Another area within healthcare which has gotten a lot of attention recently are drugs targeting diabetes and obesity, two of this country's biggest healthcare problems, with more than 100 million Americans considered obese. While many companies are developing solutions to address this area, Eli Lilly and Novo Nordisk are the current leaders in the space, with both having developed GLP-1 solutions, the most effective medications currently approved for weight loss. These medicines have successfully reduced patients' total body weight by between 15 and 25% and have been welcomed by the market. Novo Nordisk was first to market with GLP-1 medications, Ozempic and Wegovy. And while these have been wildly successful, Lilly's Mounjaro and Zepbound medications have provided more benefit in the form of greater weight loss. Morgan Stanley speculates that Lilly could be the first trillion-dollar biopharma stock. All of the medications previously mentioned are delivered by the patient or close acquaintance administering a shot. Other companies are developing oral alternatives, although none have been approved yet. So this is sure to be an evolving and important area of interest for a long, long time. Let's move on to the next slide, please. So there are a number of areas of opportunity within the industrial space. Deglobalization and reshoring have been important issues following the U.S.'s dependence on countries which may be considered bad actors for important medical supplies, pharmaceuticals, and technology, specifically semiconductor chips during the pandemic. This has led the government to enact legislation that certain items be manufactured in the U.S. One example is the $39 billion CHIPS Act, which provides assistance in the fabrication, assembly, and testing of semiconductor chips in the United States. Beneficiaries of this act include NVIDIA, Broadcom, and Microchip. Pharmaceutical companies such as AbbVie, Eli Lilly, and Johnson & Johnson will benefit from other reshoring laws targeting the healthcare industry. And just yesterday, it was reported that the U.S. will invest billions in the domestic manufacture of cargo cranes, seeking to counter fears that cranes built in China, which include advanced software employed at U.S. ports, pose a potential national security risk. Additional industrial innovations include the evolution of the aerospace cycle, with companies such as Parker Hannifin, RTX, which was formerly known as Raytheon, and Honeywell, all of which are parts suppliers benefiting. Automobiles are adding additional safety and autonomous driving features, which require more and more sensors and parts to operate efficiently. Illinois Toolworks, NVIDIA, and Amphenol are suppliers in this area, and Tesla manufactures electronic cars with self-driving capabilities. Reducing energy usage is part of the green agenda, which has gotten traction over the past few years. Solar companies Enphase and First Solar, and wind energy companies NextEra Energy and Vestas Wind Systems are important contributors to this effort. And there are many additional areas of opportunity in other sectors, such as the financials or interest rate movements create opportunities amongst the banks. I will now turn it back to Bob, who will summarize the presentation.
Thanks, Phil. Thanks, Brian. A lot of meaningful and interesting information, which certainly gets our attention and keeps us quite busy. But in summary, given the decline in M2 growth, monetary growth, and its historical relationship with inflation, we believe inflation will continue to moderate. The trend should remain on a downward trajectory, but month-to-month results will be choppy and perhaps cause a bit of volatility along the way. Despite declining inflation, the Fed is likely to hold rates higher for longer to avoid the stop-and-go monetary policy mistakes of the 1970s, excuse me, where inflation reaccelerated. This likely means the Fed will wait longer to cut rates and will cut less this year than the market is anticipating. And some of that is already baked in with the fact that the Fed pretty much said they were not going to reduce rates in March. Inflation in certain areas may remain sticky and could have an impact on consumers. We're particularly watching the Middle Eastern war, where the Houthis are bombing, attacking ships in the Red Sea, and this is causing some of those ships to go a much longer route, which could create a little bit more inflation. So we're watching that. The economy continues to do reasonably well. Overall, consumers are in good shape with debt levels well below prior peaks. We already showed you that there are excess savings. Employment remains a bright spot, while wage growth is outpacing inflation for the first time in 2 years. And that'll help the average American catch up a bit. Business conditions remain favorable despite the rise in interest rates, or the recent backup in interest rates, where the 10 years back up to around 4.25. Earnings growth is projected to continue over the next few years. Things like AI that Phil talked about will help margins, and not just margins in technology companies, but margins even in manufacturing companies or distribution companies, where artificial intelligence can rationalize and make more efficient the manufacturing process, the distribution process. So this is truly the potential for a disruptive technology. Increasing index concentration is something to be monitored, but what makes this time different is these are real companies with real earnings in secular growth trends that are not trading at astronomical valuations. And again, we contrast the Magnificent Seven or the Glorious Five, as a couple of them have not done quite as well this year, are producing a great level of earnings. This is to be contrasted with what happened in the year 2000, when technology had a very large part of the S&P, but many of the technology companies that led to that large allocation of the S&P had no earnings. The companies that we're talking about, and you've heard reference to today, have significant earnings and significant earnings growth. So we're in a much better position, in our opinion. Growth has outpaced value in aggregate over the last 17 years, and that trend is continuing so far this year. These trends tend to move in cycles, but can switch quickly, so it makes sense as part of a prudent asset allocation to have exposure to both styles, growth and value. Value outpaced growth in 2022, that tough year, and of course, growth came back and trounced value in 2023, and is leading the pack so far this year. And we still don't love international. Secular growth trends are very important to the future direction of the market, which we continue to place a heavy emphasis or heavy research emphasis on, as Phil pointed out. When you look at some of the companies that have been mentioned, they're new, they're dynamic, they're disruptive, and they're profitable, and they're growing. So there is a lot of hope in terms of finding areas for us to invest in that should be fruitful to you as our clients. The US government has approximately 54% of its outstanding debt maturing in the next 3 years. We believe this was a policy error by this current administration, as they should have capitalized on the low interest rates in 2020 and 2021 to extend maturities, which could add to market volatility as we go to refinance that debt at higher levels. Again, there's one big pie of the potential revenue we have and as a government, and we're now paying more for interest. We're also running a higher deficit. So this is an area of concern that needs to be focused on by our elected leaders down in Washington. And finally, ongoing geopolitical hotspots, Russia, Ukraine, Israel, Gaza, and the other Iranian proxies, Iran and China, as well as our own political divisiveness, need to be watched. This is an election year. There's a lot at stake. As we mentioned earlier, the average American is unhappy with the economy because of inflation, yet we have a growing economy and full employment. So there are a lot of issues to be considered when it comes to voting in November. And of course, we have these geopolitical hotspots that we're watching carefully to make sure and hope that they don't spread beyond the regions they're in. As a matter of history, markets tend not to be particularly roiled by regional conflicts. It's only when they go beyond the region that there could be a greater exposure to our equity positions. And with that, I will turn it back to Dina for Q&A. Thank you.
Thank you, Bob, Phil, and Brian, for sharing with all of our participants. We're now going to begin to answer questions from our audience, and we've gotten some great questions already. Please continue to send your questions over, and we'll get to them as many as we can. So the first question that came in today is, do you think the equity markets are overvalued?
All right, let me take that, Dina. It's a good question and a very timely question. If you look at the cap-weighted market, the S&P, on 2024 projected earnings, the S&P is trading at about 20.6 times earnings. One could say that's a little high, a little lofty. But with the 10-year bond being at 4.25% roughly, it's certainly not nosebleed. Nosebleed to us was in 2000 when the S&P got to about 28 to 29 times earnings. So 20.6 times earnings cap weighted, which means that the big technology companies, which have higher price earnings multiples and significant earnings, weigh more heavily on the index. 20.6 is slightly elevated, but nothing to be too concerned about. But on an equal weighted basis, where all companies are in the 500 are considered equal, it's 16.6 times earnings. And that we view as much more reasonable. So when you broaden out the answer to the question and you look at all 500 companies, it's 16.6 if they were each considered on an equal basis, 20.6 on a cap weighted basis. And that's based on 2024 earnings. On 2025 earnings, again, projections, cap weighted is 18.2, and we expect interest rates to come down, which would tend to support a somewhat higher PE. But we go from 20.6 in 24 to 18.2 in 2025 for cap weighted, and then equal weighted drops to 14.6, again representing what we consider to be a very fair or undervaluation for the general market at 14.6. But again, that would require some broadening out of the market. So, valuations are not tremendously stretched. When you look at alternatives, such as in the fixed income area, we believe that equity markets are still attractive for the long term. And as the quote I used earlier from Charlie Munger, may he rest in peace, the great investor, you make a lot of money by waiting. So we're patient investors. If you're in the right companies, given these valuations, we should do reasonably well over time.
Thank you for that. The next question is, what is FLI underweight fixed income?
I'll take that one, Dina. So we underweight fixed income because real returns matter. When you look at where fixed income is trading today on an after-tax basis relative to inflation, you're not earning much of a real return. So you're about keeping even with inflation, and over time you really need to outpace inflation to keep up with, living a lifestyle that you're accustomed to. So for us, it's really what really matters again is the real return, and that's about equal with inflation, whether that's on a taxable bond or a tax-free municipal. You're getting about even with inflation returns, which doesn't help grow your wealth over the long term. So, while it's an important part of the asset allocation and is there for stability and to provide income, it also, we also remain underweight because it doesn't help us, grow your wealth over time.
All right, thank you, Brian. So our next question is a two-folded question. The first part is, what are the implications of the election cycle on our investment portfolios? And the second part is, should we be making any changes to our asset allocation in response to potential volatility?
Since I'm somewhat of a political expert internally, I'll try and answer those questions. The current environment is one where most Americans are unhappy with the choices for president in both cases for different reasons. And the margin of difference in both the House and Senate between who controls and who doesn't is also about as slim as you've seen in history. So it's an important election cycle, and it's very hard to handicap who will do better. As we said earlier, the majority of Americans are unhappy with the direction of the country. The majority of Americans think the economy is going in or has gone in the wrong direction, even though there's full employment, truth be told. And most Americans are working. There are many Americans who are unhappy with the so-called invasion across the southern border, which is now spread to the northern border. So it's very hard to say which party will succeed in November, but it's important because the tax law of 2017, as created by the past administration, sunsets, or aspects of it sunset beginning in 2026. So that if there's continued paralysis in Washington and nothing gets approved as relates to the 2017 tax reform bill, where nothing is changed with it, then the SALT deduction, which affects many of us in New York, will be fully reinstated. But the negative will be that the lifetime exclusion, which today approximates 13 million plus in terms of what you can either give away during your lifetime without paying a tax, or utilizing it upon your passing for the benefit of your estate without paying tax, would revert back to something north of $5 million. And also, I believe, although I'm not 100% sure, that the tax rate, which dropped from 39.6 to 37 for individuals, will go back to 39.6. So it's very hard to say. We're monitoring this very carefully. And you can expect that we will be back to you as we see anything. There have been efforts in Congress that did not succeed to liberalize the SALT deduction, particularly for those in New York, California, New Jersey, and elsewhere where there's high individual state tax rates and real estate taxes. That was unsuccessful. It was tried by the Democrats at one point, and it was tried by the Republicans most recently. And in both cases, there was no success in liberalizing SALT, which was taken away to a very, very large extent in 2017. In terms of what our clients should do in terms of our portfolios, remain diversified, invest in high quality businesses. I think Phil did a great job outlining some wonderful areas to invest in with some wonderful companies that present real investment opportunities. And those investment opportunities, that growth in earnings, the growth in dividends from those very solid companies will prevail over whatever the policies are coming out of Washington for the most part. So keep in mind, you don't invest in stock symbols. We own pieces of businesses, or we own pieces of real estate, hopefully that are well located or high quality. They were all high quality, we believe. And that will win the test of time, in our opinion. So I'm not sure I answered that fully. It's a hard question. We're hard questions to answer. But it's going to be an exciting year, given the divisiveness in the country, which is unfortunate. Probably the most divided the country has been in my lifetime. But hopefully we get a leader that brings us together, or we get some common sense in Washington, and we make some progress. There are issues such as Social Security and Medicare that will run out in 8 to 10 years, and some adjustment has to be made, or something has to be done to safeguard those contractual obligations that the government has to all of us as Americans. I don't know if that answered it, Dina, but I did my best.
No, thank you for that. We have time for one last question. And if we don't get to your question, we will reach out to you individually so we can answer it for you. So the last question we have for today is, what are your thoughts on real estate?
Okay, nobody's volunteering, so I will volunteer. Real estate remains a good investment area, but there are certain issues in certain segments. The office market is still suffering from COVID, and the fact that although there are many more people going back to work in their offices, there are still some that are not. So vacancies are a factor in certain areas of the office market, as well as many of the real estate transactions that took place in the last several years were done at historically low interest rates. Unfortunately, the developers of those real estate projects were short-term in their thinking, and they need to refinance that real estate now at much higher rates. You know, we know that personal mortgages several years ago were maybe 3%, where today they're 7%. So the same issue is affecting commercial real estate, particularly in the office area. Where we see opportunity in real estate is multifamily and certain industrial warehouse locations as the economy continues to expand, as you see the reshoring that Phil mentioned earlier. All of that will contribute to industrial real estate and warehousing probably doing better. And multifamily, as you may know, we have many more people in this country now, some legal, some not legal, and we have a growing population, and therefore multifamily housing we view as a favorable area in particular parts of the country. Given the regulations in New York and the tax structure of New York, we wouldn't be fans of investing in the New York area right now. But other areas of population growth where the local governments are more pro-business and pro-citizen, you can say Florida, you can say Texas, you can say the Carolinas, you can say Tennessee. Those areas are thriving and we think represent opportunity.
Thank you. So that was the last question we had time for today. So on behalf of the entire FLI team, I would like to thank everyone for joining us today, and I hope you all found the session interesting and insightful. If you have any friends or colleagues who you think could benefit from joining future events like this, please let us know and we'll be happy to include them. For our clients on the line, I would like to remind you that our investment committee is always available to discuss your individual asset allocation. Please reach out to them and they can assist you. Everyone, have a great day, and I hope you enjoyed the seminar.
Thank you very much.
Thank you, everyone. Take care.